Welcome to the India Fintech Diaries, the only podcast focused exclusively on the Indian fintech market. I'm Elroy.
And I'm Hemant. In each episode, we dive into the latest trends, ideas, innovations, business models, and personalities that are shaping India's fintech landscape.
We also invite amazing guests who are innovators and industry players that are driving the change that is helping make financial services more modern, innovative, and inclusive in India. Come join us as we explore the changing landscape of fintech in India.
Hi everyone. Welcome to the latest episode of India Fintech Diaries. I'm your co-host Hemant, and this is the show where we discuss the latest trends in Indian fintech, speak to some amazing guests from the industry, and dive deep into the specific fintech themes.
Hi everyone, I'm your co-host Elroy. In our last episode, we gave you a quick look into the fascinating world of buy now, pay later. Today, to discuss more on this topic, I'm very pleased to bring on the show one of the pioneers of this segment in India. I'm very pleased to welcome Nitya Sharma, co-founder and CEO of Simpl, the firm that's been at the forefront of the BNPL movement in India. Welcome to India Fintech Diaries, Nitya.
Thanks, Elroy Hemant, for inviting me, and excited to be having the chat with you today.
Nitya, you began your career as a structured credit and credit derivatives trader in the US, working for firms like Bear Stearns and Goldman Sachs. Tell us a little about your journey from working in the very arcane world of finance to founding one of the leading BNPL payment firms in India.
It definitely seems arcane compared to Simpl. My background is I grew up in India, then I moved to the US to go to grad school. And then, as you said, I first started my career at Bear Stearns, trading mortgage-backed securities, which was a very exciting time. I worked at Bear Stearns from 2004 to 2006, 2007. Which was the best of times for all the financial innovation that was happening on Wall Street, mortgage-backed securities, CDOs, etc., which also created the leverage which led to the financial crisis, the global financial crisis. So kind of saw that whole thing. And then after Bear Stearns, I worked at Goldman Sachs in New York, trading structured credit correlation. And then I was at a hedge fund also in New York. So spent 10 years on Wall Street just doing that type of stuff and honestly loved it. Was not really planning to move back to India and start a payment company. But at some point, I kind of realized I want to be an entrepreneur. It was very clear to me. As I was just thinking about what I wanted to do and spending some time just traveling, I just wanted to kind of like have a little break. I was in India and my bank in India rejected my credit card application for a simple reason that in India, I did not have a credit score. And as a finance professional, I understood what happened. But as a normal consumer, it really occurred to me, shouldn't getting a credit card be sort of as simple as getting a smartphone, right? You go to a bank, you have a relationship with them, and you get it. And it didn't happen to me. So that's when I kind of just fate took a bunch of twists and turns to get me to start Simpl.
That's very interesting, Nitya. BNPL is a very popular topic these days with plenty of new fintechs entering the BNPL market pretty much every day. But everyone seems to have their very own definition of BNPL. For instance, if we look at Max Levchin, who's the CEO of a firm, a US-based BNPL provider, he's actually called a debit-based BNPL product as the anti-credit card. So I'm curious, what's your definition of BNPL?
I think, anything new, any new innovation typically is misunderstood for a very, very long period of time, and also has different versions that eventually sort of solve consumer and market problem. The way we think about it, and when we started Simpl, there was not really a thing called BNPL. No one ever used that word, etc. We started for a very important insight, and I'll just give it to you and your listeners to appreciate how we think about it. So, when I got rejected for a credit card, obviously I was like, okay, well, this is broken. And I realized most people in India just do not have a credit card, which is very different from developed markets like US. So, as you know, only 3% of the addressable market in India have a credit card. 30 million unique people have a credit card compared to 900 million people who have a bank account and a debit card.
Right.
And then you see evolution of commerce in India. E-commerce is happening. E-commerce is on the mobile phone, but 70% people still use cash to kind of pay for what they buy. And then on the other side, you see this phenomenal infrastructure development on the banking side. Everybody has a bank account. Everybody has a debit card. There's UPI, the whole nine yards. And yet people use cash. And one thing was very clear to me. One of the reasons that is driving the usage of cash is trust. People, especially in online commerce, people use cash on delivery to build trust in commerce. And when you think about developed markets in e-commerce like US and so on, credit cards typically take that space where a consumer can save their credit card online or on Amazon or Uber. They can do their one-click checkout, and it's a pretty good user experience. And you feel safe as a consumer that if there is fraud or some chargeback, your credit card will help you. But in a debit situation, it's really your problem. So it was very clear to me the missing link is the credit card. And the opportunity that I thought was the real opportunity is not to build a credit card company, although that could be done too. I was like, how can you reimagine the whole thing? How would you build a credit card grounds up for today's technology, for today's commerce, for today's consumer and today's retail, if the credit card did not exist at all, right? If you were just starting from grounds up. And that's how we started Simpl. Now, as we were starting, or at least as I was conceiving this idea and thinking about how to even start, what really inspired me was this concept of the khata. So I was living back in India. I live in Bangalore. I live in a building. There is all these stores near me, and they, the grocery store, the liquor store, the pet store, the dry cleaning guy, the newspaper guy, the milkman, they all run a tab or the house account or a khata, as it's known in Hindi, on me. And it's obviously, as you know, very common in India. It happens in upper middle class neighborhoods. It happens with all sorts of neighborhoods. It happens in big cities like Mumbai and Bangalore. It happens in the smallest of villages. Rich people use it, poor people use it, old people use it, young people use it. So it's kind of like everywhere, and it's been around for centuries. It's actually been, if you study human history or anthropology, it's been around for 5,000 years around the world. And so to me, it was very clear. This is the credit card of India. It is informal. No one is building it. No one is productizing it. It is literally pen and paper. But it's around. It's around. It has Lindy effect. It doesn't go away. And the question is why? And the answer to that question is the sort of the insight. And the answer is in how we think about it is, for a retailer, the khata or the tab or the account helps them build a relationship of trust with their consumer. Right. So the kirana store is not giving me a loan or some sort of a financial services or all the seriousness that goes with it. They are giving me a top class consumer experience, making me feel special, which translates into a relationship between the two of us, which, if you think about it, translates into almost like a subscription type relationship between a retailer and consumer. You can consume with the retailer as much as you want for a fixed period of time, and it's a great experience, and then they give you a bill, right? So naturally, for a retailer, it builds a relationship, and they want. On the consumer side, one thing we say at Simpl and how we build our product is the best payment experience is no experience, and the khata or the act of buying on a tab or a account is exactly that, right? There is just no experience that is called the payment, and therefore consumers just love it. And so I said, well, if I'm able to take the concept of the khata and put it on the internet, right? Reimagine it for sort of the technology we have today, which is put it on the cloud and the internet, and put it on a network, right? So that it's not different khatas on different retailers online. It's different khatas, but connected to each other on a common network, so that the network manages identity, trust, and risk, because the network has the cross-network data to be able to solve these problems. The retailer can run this khata type product, ease of usage type product for their customers. And on the consumer side, they will be able to use this beautiful user experience, which is absolutely no experience, or what we call zero friction experience of payments, and
Right.
get one bill for everything, one bill for all transactions you do across 15 days and get a bill. That is exactly like a credit card, but a completely new version of it. A credit card that is not something that is built on a 60-year-old legacy technology value chain, but really something that was built with today's technology, but connecting the merchants and consumers directly so that they can interact, build relationships, and build trust. And the version of the khata we are building, or so the version of the BNPL we are building, is the khata. Okay. And that's what I always differentiate. There are two versions of BNPL. One is a lender giving you a loan on you wanting to use that, call it BNPL, you can call it EMI, you can call it whatever, or a credit card even. And then you can use it wherever you want for whatever purpose, whatever the terms and conditions are. The other BNPL is the khata. And to us, that is the most important version of the BNPL. And that's what we are building. And the reason it is disruptive, that version is disruptive, is it is taking a completely new approach to sort of value chain creation. Because if you think about lending as a BNPL, it's like a credit card. It's a lender giving you a credit card or a loan or whatever, and then it gets inserted between a merchant and consumer to create a value chain that is sort of, kind of like a credit card. But if the retailer is able to give you this khata, then you are just taking out everybody in the middle and connecting the retail and consumers together while solving the problem of identity through a separate value chain of creating a network. So at a high level, that's how we think about two versions of BNPL. The version of BNPL that Simpl is building is not a loan. It's a khata and it's an invoice-based buying for consumers on retailers.
Nitya, that's very fascinating. And what I love about your approach to this problem is one, you did not design by analogy, but it was pretty much designing from first principle. The second is that you actually went back to your own experience, your own roots of living in India and looking at experience or a way of operations for your own people and designed and took inspiration from that to design the specific product. What that brings me, Nitya, to is the first question which I had is, who is your typical customer for this particular khata based innovative product? And second is, what is driving the adoption of such a product for a customer?
Absolutely. So if you think about it, right, something like Khata or BNPL has two customers: a retailer or a merchant on one end, and a
Hmm.
user or a consumer like you and me on the other side. So I'll start with the
Right.
retailer first, because that's how we think about product creation here. We call ourselves merchant first and empowering merchants to be consumer centric. Because if you think about it, Khata is like that. Khata is not about some company coming in the middle and sort of aggregating the consumer, but Khata is the retailer, giving it to the customer so that they can build a relationship. So we start with the retailer. So for a retailer, if you think about commerce and you build a spectrum of commerce, and if you were to go from left to right, where on the left is high frequency commerce, and on the complete extreme right is low frequency commerce. So that's your spectrum, and there is obviously all sorts of things in the middle. So in the high frequency or high frequency commerce, what are the typical things? Well, you buy coffee, you buy food, you buy grocery, you go to the movies, things you do very frequently in a month as a lifestyle with your family, yourself, etc. So that's very high frequency commerce. And then on the complete extreme right side is low frequency commerce, which are things like you buy things that you don't buy that frequently: your couch, your washing machine, your air conditioner, your phone, your computer, your Peloton bike, etc., etc. Those type of things. And then, of course, there is the entire range in the middle, right? Your t-shirts are slightly less frequently, or shoes and some lifestyle discretionary purchases you buy more frequently than a washing machine, for instance, but less frequency than food, for instance, right? So that's kind of like the spectrum. And if you think about folks who have credit cards or around the world, when people just adopt credit cards for everything, people use the credit card to buy everything, right? From the coffee to sort of the couch, right? Now, if you think about it as a consumer, as you're consuming these services from retailers online or offline, the credit card or whatever instrument you're using is solving a different problem for a coffee versus the couch, right? And what you value is different, right? So on the high frequency stuff, you're valuing user experience a lot, right? The reason
Right.
you use your credit card to buy coffee on a Starbucks is not because you're looking for a loan to buy a 200 rupee coffee. Is
Right.
because of the user experience, whatever that means, but the user experience. And then, of course, when you buy your couch, and if you can finance it, that's a loan, right? So we focus on the user experience and the trust part of commerce, which automatically means we focus on the commerce, which is extremely high frequency. So
Hmm.
we cater to commerce establishments on the online side, which is food, grocery, movie tickets, all that type of stuff, and then of course slightly less frequent also, which is lifestyle discretionary, shoes and sneakers and lifestyle stuff and cosmetics, FMCG, etc. So that's where our focus is. One place that's not our focus right now, at least, and we don't expect it'll be for some time, is things, as I said, that you do very infrequently. You buy your couch, air conditioners, and washing machine, which typically is how people think about traditional EMI, right? When you get your Bajaj EMI or something, we are not focusing on that at all, because for us it is incredibly important to really be in a consumer's life very, very frequently, every day, if possible, every week, and definitely every month. So that's kind of like how we approach. So I explained the retailers that we work with. That we work with 4,500, more than 4,500 retailers like that. And now on the consumer side, our typical customer is a customer who's young. So the age group would be anywhere between 21 years to sort of 35 years would be
Okay.
the typical range, and the sort of the median would be about 28. They are typically urban, and when I say urban, they live in tier 1 or tier 2 cities. So one of the top 15 cities in India, let's say. So definitely the Mumbai, Bangalore, and Pune and Delhi of the worlds, but things like Lucknow and Coimbatore and Ahmedabad and Hyderabad and so on. So that's where they live. They are English speaking. They typically have a job, and their salary is anywhere from sort of 40,000 rupees a month to 2 lakh rupees a month. Now, obviously, we do have customers who have 5, 10, 20 lakh rupees a month salary also. They have Amex Platinum cards. They still use Simpl because it's just a great user experience. But the focus area is this, the urban millennial consumer. And if you think about the urban millennial consumer, obviously in a month, what are the things they do all the time? They buy food, they buy grocery, they have a lifestyle, and then they buy shoes and clothes and all this stuff, right? So that's the customer we are going after. And the interesting thing about this customer, Elroy and Hemant, is
Yeah.
when you think about this customer and you really think about this customer today versus like even, I don't know, 20 years back or even 10 years back in India, what is happening in the world is this millennial and then of course all the Gen Zs and all these words that I don't even recognize anymore. But think about the people who are in their late teens and 20s. They are a very horizontal consumer class globally, which means the consumer that we are talking about in Mumbai, Bangalore, or Delhi is exactly the same as their counterpart in Tokyo, Singapore, Sydney, Nairobi, San Francisco, New York, or London. There's the same consumer. And the reason there is the same consumer is they have the same expectations of various things that they consume, especially online. And the reason is they consume the same things. So if you think about it, everybody is using Spotify for music. Everybody uses Netflix for movies. Everybody uses Uber or Ola type, one version of that, and depending on their country for transport. They use
Right.
Amazon. They use Tinder to go on a date, right? It, for them, the world is so different from sort of the world I kind of grew up in, probably, right? And if you think about it, for them, user experience is everything. Transparency of terms and condition is everything, and being aligned. They love using products that are aligned with their value system, right? So they're not, hey, I'm someone and like a bank wants to give me something. I'm so happy. I'm so grateful that somebody's giving me a loan or a credit card. They're very independent thinkers. They're very, very selective, sort of, etc. And what they definitely appreciate is user experience, and they expect the same thing across the world, right? It's not like the Indian person is okay with slightly less good version of a Spotify. No, they just want the same
Right.
thing, one click and unlimited songs in their pocket forever for like whatever 500 rupees, right? So and we are building for that customer, that evolved, intelligent, urban middle class who really wants great user experience, extreme transparency, and alignment with their value system.
That's quite a fascinating dissection into your customer segments that you look at. And Nitya, from what you described, it looks like this is a classic two-sided network. And at least from my experience and what I've seen, these are actually very difficult to establish and scale. But you seem to have done phenomenally well at Simpl and scaled this to what, about 4,500 plus online stores. And if I recall the numbers that I'd seen previously, about 1 million plus active customers. So what are some of the
Yes.
challenges that you faced while scaling this network?
So building something like this, you have to think of this in different sort of acts, right? So when you build, different companies have different sort of how you approach
Yeah.
business or company building. The way we thought about Simpl was Act One, Act Two, sort of Act Three. So the Act One and Two were things like building out the infrastructure. So first is, as you said, solving the chicken and egg problem, right? It's a
Yeah.
two-sided network, and again, the reason consumer uses Simpl to buy food online is not because you can use it in one place, right? The aggregation of all the bills, just like credit card, right? All the transactions or as many transactions is the value, and therefore, if you don't have sufficient sort of network, then the value is diminished. So it is a complicated chicken and egg problem, and I'll talk about it how we solved it. And then you're building a infrastructure around identity, trust. How do you score these people? Because you can't use traditional methods because, again,
Correct.
no one is looking for a loan. So no one will deal with the user experience that kind of goes with giving a 50,000 rupee loan type thing, right? So how do you underwrite? How do you onboard? How do you, learn about the customer, know your customer type thing? And it takes time. There's no playbook to it. As you said, we approached it completely from, fundamental building blocks, the first principles of how to think about identity online, how to think about building trust online, how to think about, running it in a business model that is profitable at the same time, a great user experience, So, that was our Act One, and of course, Act Two is very quickly scale, which is what we're doing over the last 1 year. And the way we solve the chicken egg problem is, again, Khata. Like, we go back to Khata. Khata is our, it's the fountainhead of sort of all creation of Simpl. We work with merchants very, very deeply and closely to solve their problems. And they have two problems in India. One is cash. People use cash, and it's incredibly expensive for retailers. It's like, it doesn't work in the end. It's just a necessary thing people have to do. And most people use cash to build trust. Simple,
Yeah.
buy now, pay later, one click checkout, and pay later after delivery builds trust, and it's a great user experience. And so obviously we amongst other things, we also move people away from cash. So retailers work with us very, very deeply, and they distribute our product to their customer because obviously they want to solve the same problem as we do. The second is conversions. One of the seminal problems in e-commerce is that every retailer, big or small, and this is actually a bigger problem with the smaller retailers and not exactly the Amazons, they have to market, build a brand, spend a lot of money, building the top of the funnel. Oftentimes, they spend anywhere from 20% or 20% to 40% of their revenues on marketing. The
Yeah.
problem is the top of the funnel is there, but the conversions are very, very low. And the reason conversions are low in e-commerce obviously is all the friction, all the speed bumps that you have. It starts with anything under the sun, but it's definitely two very important things. One is the checkout friction, and the second is trust, right? Imagine a consumer buying a t-shirt online and like, oh, and the trust is not about, is the merchant going to be a fraud or anything. That's not the point. The point is the trust around the internet service, will the delivery happen on time or not, and if it happens, will the return, refund, the whole nine yards. And so people just feel safe just paying with cash, right? So that if anything goes wrong, it's not their problem.
Yeah.
And so we solve that conversion problem through a frictionless checkout, one-click checkout, and of course, a great user experience around, hey, you have to pay after delivery. And so we increase the conversions for retailers. And depending on the type of merchant, we increase retailer conversion from anywhere from 50% to 300%.
That's
When
amazing.
when you solve conversion, you basically are a marketing company. You're not even a payment company or a BNP. Like, we ourselves don't think of ourselves like clearly like a pure play payment sort of platform or a BNPL or something. We think of ourselves as being a partner to retailers to increase the revenues. That's the company we are. Now, of course, BNPL is a part of it, and a few other things we do, and we'll do so many other things to keep on doing that, solve that problem, like loyalty and so on. But that's what we are. And because we align ourselves, our business model, who we are, etc., with retailers, they obviously work with us and help us solve the chicken and egg problem. And that's kind of solved for us. So they distribute the product on the consumer side. So we are B2B2C that way. But we also build a consumer side relationship. And I think one thing I will just like very quickly put a pin on, Hemant and Elroy, is one of the things that is understated in Indian e-commerce, especially payment market, is when you think
Right.
about the large sort of the big payment companies that we all know of, one of the problems that they have in the ecosystem is that they all, in one way or the other, compete completely or a little bit with retailers itself. So if you think about
Hmm.
Paytm, Amazon Pay, Flipkart, there is an element of competition between the
Right.
retailer of different sort as a parent companies, and we are the sort of the neutral visa type platform that enable merchant success. So that's really the and again, that's what the Khata is, right? So that's how we think, and that helps us solve a lot of these critical infrastructure, data, and distribution problems.
I'm also curious about the technology behind Nitya Simple. And the reason for this is because today, if you wanted to start a lending company, for example, right, you'd actually be spoiled for choice to find a state of the art loan management system and a loan origination system, for example, to set up your business. But for BNPL as such, you'll find very few technology providers. So I'm curious, how did you go about solving for technology to power Simple?
Yes. Look, in the end, we are a technology and data company, and therefore building that out and continue to build it is the core IP we are building. Now, just to give you a sense, when somebody uses in the world, anywhere in the world, let's say in the US, so if you think about what Simple is, Simple gives you one-click checkout like Amazon one-click checkout, a pay later
Yeah,
facility like a credit card, and
right.
it integrates with retailers like a payment gateway like a Stripe or something.
Correct.
Now, when you think about a person using their credit card on Amazon, let's say one click checkout in somewhere in the world, and when the consumer hits one click checkout button, I mean, obviously it's a great experience, but behind it is a very complicated value chain that starts with an issuing bank and then a network and then a processor and then there are so many companies who are solving the fraud problem and then there are payment gateways and there is acquirer and then finally the merchant, right? So there is a legacy sort of a value chain that is massive in scale, has been developed over a 60-year-old sort of horizon, right? So it started 60 years old back with some sort of version of the value chain, and as complexity of card payments change with internet and so many other things, different people inserted themselves in the value chain. But they solve an important problem, but they solve it in a sort of separated way that there is no data sort of one data stack. It's just different people doing their own thing. Now, so if you think about what we have built is we have built the whole thing, right? We are not a sort of a layer of something that is solving a specific problem in the
That's right.
value chain. We have rebuilt the whole thing, which starts from the acquisition of the merchant, the integration of the merchant, and then upwards to the consumer. And yeah, I mean, it is definitely a complicated technology. And the reason it's complicated is it has to work at massive scale. It has to work at incredible speed, and it has to be incredibly secure and reliable system. And most importantly, it has to be intelligent. Because the problem with the credit card today is it's not intelligent. Think about the credit card that's sitting in your pocket. It is the same credit card that you got 2 years back. It's not getting smarter with time. But then you think about any internet application you use, and that was my point about millennials. You use Spotify, you use Google Maps, you use Netflix, you use whatever else. They become smarter, right? The Spotify 2 years back is nowhere close to how good it is today. Google Maps today is much better than what it used to be 5 years back. But credit card is exactly the same, right? If you got your credit card 10 years back, there is zero improvement. So data is just not a part of the whole thing, right? It's just like it is sort of like how things were built 6 years back, and because we are a full stack and data is sort of the main thing. It just gets better with time. So the intelligence of the stack is the very important value. So no one can build this. At least look, I mean, people can build a, like I said, right? A loan management system is obviously only the smallest part of this whole thing, like ledger
Yeah.
as we call it, right? It's like a database, and I'm sure there are companies who deliver that as a SaaS service. But really, to build this, you're not building a loan management system, because if you are, then you are thinking of it in a very traditional way. It's like, okay, I'm giving a loan to a consumer, and then of course, hopefully, they'll take it somewhere. But if you're building the way we are thinking about it, you're just building the whole stack. Yeah, you're right. I mean, I don't think there is a SaaS provider who kind of like is there who has built it. And look, the reason no one has built it is you can't build it. Like, how can you build it? Let's like say, oh, let me just build it today. No, you just have to go through the whole process first, right? So,
Right.
how do you underwrite? How do you do this? And how would you integrate with merchants? And, it's not like when we started, we knew exactly what to do, because, there is no playbook. So you have to do it. You have to learn. You have to have your failures and finally figure it out, and then you do it in a way which becomes easier and easier and easier, so to the point that becomes you know something that could be integrated by a retailer in 10 minutes. Of course, we do not start there. So that's kind of like the stack and the technology we have built. Of course, the team we have is incredibly talented, who has created the whole thing, and that's a serious IP that we built.
Awesome, awesome, Nitya. Now, Nitya, listening to you, it is very clear that you have looked at a consumer requirement which was there, thought about it, and rebuilt everything from ground up. whether it is the experience, whether it is the product. And that in turn means that the business model also cannot be the same as it was for the earlier product which was serving the same need. So, can you give us a peek inside the business model which is there for Simple?
Absolutely. I think that's a great question. And I think this is something that I think most people sometimes conflate that, the credit card aficionados would be like, oh, what is wrong with plastic and all that. So, I mean, there's nothing wrong with the plastic and it's totally fine to have plastic also. When you build the opportunity, oftentimes, and it sometimes come in the world where there is this total new confluence of new technologies that just did not exist that could be put together. For instance, if you think about, I'll get to the your question in a second, but if you think about what are the things we leverage today that probably was not even possible 5, 6, 10 years ago, is we leverage smartphones,
Yeah.
internet, high-speed internet, cloud computing, and machine learning all together in a way where it has to work together and not separate. Right? That is super important to understand. Now, 10 years back, that could not be possible. Definitely not in India, most parts of the world. And then the last thing is the fact that shopping is happening on the smartphone. Are those 5, 6 blocks that when they come together, you have something explosive or true opportunity to sort of like completely redesign the value chain from a business model point of view. So coming to your business model question, I'll get to the economics and stuff openly, but the key difference is that when you think about a credit card based payments and the entire value chain that makes it happen online or
Right.
offline, they are right now adversarial to the interests of merchants and consumers, not only in India, but globally. And this is why. When you think about what happens when you buy your coffee at a coffee shop, well, the coffee shop guy is paying and by the way, this is true around the world, anywhere from 2.5 to 2.9% plus some fixed fees, so 5 rupees or 20 cents or whatever, something like that is what they're paying. If you break down this cost, or sort of this revenue stream of 2.9% plus few cents and rupees, and then you ask, what is the cost structure of this transaction? Like, what did it cost to create this product at the back end for that unit of that interaction or transaction? You would realize that 2% out of this sort of 2.9% was going towards the loyalty rewards of the consumer, which obviously as a consumer we all love. Now, when you think about who's building loyalty here, well, the bank or the issuer of the card is building loyalty here. And then you ask the question, who's paying for it? Well, the retailer is paying for it. Well, is
Yeah.
the retailer happy about it? Of course not. I mean, the retailer would rather, build loyalty. Like, as I said, the khata is all about the retailer going above and beyond to build a loyalty with the customer. And, when you think about coffee shops, right, go to any cool coffee shop anywhere in the world or in India, they will give you the punch card. They will give you some sort of a stamp or something like, hey, Elroy, please come here and you'll get the 10th coffee free. So
Correct.
they are giving you all these things and they want to give you the khata, the whole 9 yards, and they will smile at you. They will try to do everything to make you a loyal customer. But the fundamental loyalty, the flywheel of loyalty in a credit card is accruing to the bank. Right? And the retailer has no choice. So that's number one. By the way, just to give you a number, every year, retailers online and offline pay $500 billion to process credit card payments. $500 billion problem it is. Okay. Second, on the consumer side, we all use our credit cards and, happily. And when we think about our credit card usage, we use it like a payment, right? We use it as a transaction. We use it to buy food, grocery, going to dinner with our family, taking Uber, whatever, all these things that we do. But one of the things that about credit card business model is that the main juice in the business model comes from revolvers, right?
Yeah.
So therefore, as an issuer of a card or a product manager of sort of a card, your goal is to increase revolvers, right? Globally, 40% of all credit card transactions revolve. Now, when consumers revolve the credit card, as you know, in India, let's say people pay anywhere from 36 to 40%. When you add up all the fees that are obviously
Yeah.
not clearly transparent, it's 36 to 40%. In the US, it's similar, right? High 20s. In Brazil, it is 110%. In Japan, where the cost of capital is almost zero or negative, it's like high 20s. And we all know if you borrow money at or you kind of like have some loan like that at high 20s, 30s, 40s, whatever compounded interest rate, it's financial suicide. I mean, no one should ever do it. Yet this product works from the business point of view when the consumer gets hurt, right? So point is the value chain benefits when the customer on both ends, merchant and consumer, hurts, and that is the problem, right? And
Yeah.
that is the fundamental opportunity internet companies and new technology companies have, is how do you now solve that seminal problem? How do you stitch together new technologies to realign the value chain and counter position yourself from what is a legacy, which is now like just literally turning on their own customers? Like in economic terms, it's called rent seeking, right? I mean, rent seeking happens
Yeah.
all the time. And when somebody becomes too big and just like important and whatever, you just get secret and transparency, lack of it, and high costs are the thing, right? So that's what we do. We basically counterposition ourselves, make payments and pricing of payments incredibly transparent to retailers, and we build a product so that the business model is not something that will benefit when the customer hurts. We align ourselves with both merchants and consumers, right? Now, coming to that point, now how do we do that? Well, we price a product to the retailer, and then we price it transparently, right? So if a retailer goes to a credit card, or has a credit card company ever goes to a retailer, is like, look, we have to, we charge you this much. These are our cost structures, and this is how much we make. No one does that. We do it. We go to the retailer and say, look, to make this happen, to help you own your customer relationship, and increase your conversion, we these are our cost structure. Our cost structure is, well, some people will not pay because some people don't pay a khata. So this is one cost structure. Then sometimes there is a cost of funding, right? Where
Yeah.
if you want to take money upfront, we can arrange that for you, but there is a cost to it. This is the cost. And then of course, people have to pay back this khata, the bill, and they can use a debit card or whatever, and there is a cost to it, and this is the cost. And if we can work together to reduce the cost, we will reduce the price for you, right? So we say, look, these are the costs. We make this cost us this much, and if we can work together to reduce the risk, or the risk of not paying the bill, or the cost funding itself, like meaning, hey, like if you don't want the money upfront, we can pay you, when the customer pays, and a lot of people just want it, we'll reduce the cost for you because you don't have to pay it to someone else. And same with the transaction processing cost. If you can move everybody to UPI based
Yeah.
repayments, then that also reduces, right? And if the merchant can work with us to do that, we pass the benefit back to the merchant, right? So we align very, very, and that's the starting point. Right? There are so many other examples of this. We align very deeply with the retailer to solve that problem. Similarly, for the consumer, it's free to use, etc., and it's easy. We don't want to take an interest rate. We do, like there is just enough money in this whole value chain that you don't have to. You can make money. The funny thing about payments is, merchants complain that they are paying too much. Consumers clearly are paying high interest rate, and everybody in payment says it's a low margin business. And the reason they say is I mean, it's a clutter of all sorts of things that just doesn't need to exist right now. They were built 60 years back with very, very old technologies.
Understood. Understood. And Nitya, just I'm curious about what happens for the consumer, and there will be always few of them who do not pay. So what happens to the delinquencies?
Basically, when they don't pay, they don't pay. We obviously remind them and so on. And the whole business model is about, one, selecting consumers who are, the probability of sort of what we call charge-offs is low. And
Yeah.
then, so basically, if you think about this business model, the business model is you first select people, and depending on the product you're building and the type of value proposition you provide, you either
Right.
get positive selection or adverse selection. For example, if this was positioned as a loan or some sort of a complicated product, then obviously somebody who needs a loan to buy a T-shirt or food is obviously not going to be a sort of, from a sort of economics point of view, a great sort of credit, right? But if you are giving it a khata, then of course it's a different positive selected customer base. So that's number one.
Mhm.
The second is the biggest risk is in the first time, right? When you give it to someone, and some people will not pay, obviously, but as long as you're giving to enough people who pay, after that, once they pay, they build their own repayment history, right? And here you're never going up in terms of value too much, right? This is things under 10,000 rupees. Like you're not You're not buying a smartphone with this or a
Right.
couch. This is buying all the small things. So you're never taking too much exposure per customer,
Mm.
and the risk completely, comes down materially after the first transaction, and then continues to go down as people buy more and pay more, right? So retention of the customer and the retained cohorts is where the entire juice is, right? So it's really about so we basically, just to give you an example, we measure a metric called charge off rate,
Right.
which for us is 1.1%. It's not a book number. We don't think about it as a book, because our book is really not a book. Our duration is like 8 days, right?
Yeah.
Consumers use Simpl from the 1st to the 15th and pay on the 16th, right? So really, it's like a 7 to 9 days sort of working capital. So the number we measure is, if 100 rupees go out, how much does not come back in sort of 45 days? That is about 1 to 1.1%.
Understood. Understood. And Nitya, what is the regulatory framework under which your business operates?
Yeah. So the way we work is that this product is an invoice to the customer. We work deeply with retailers and platforms to structure it like an invoice, which
Right.
which definitely means two things. One is the consumers, and which is what the consumer want. The consumer bureau will not be hit
Mm.
negatively at all, because when you think about, if pay later again were to be structured like a loan, what will happen is each time you take it, it will be as a personal loan entry in your bureau, which is sure shot going to be spoiling your score 100%. And then, of course, if you forget to pay by mistake, then you're screwed.
Right.
With Simpl, it's a pure play khata. It's like a convenient commerce platform. This is not a financial services platform. Now,
Mm.
what we do is then these are invoices, and there are these are receivables, like how invoices are between small businesses and so on, right? It's exactly like that. And what we do in the back end is we securitize these invoices. Okay,
Okay.
we put them in a SPV, we securitize them, then we go to investors and say, hey, look, these are invoices, these are customers, this is what they look like, this is the historical data, who wants to take this risk? So we then pool this into a separate structure, securitize it, classic securitization, and we create a couple of tranches, a sort of senior tranche, mezzanine, or whatever, and then we put a little bit of our money as a sort of participating thing, just to provide some skin in the game in the early days, and yeah, that's how the whole machine works.
That's pretty fascinating, Nitya. I never thought of BNPL or structuring something in this fashion. That's pretty interesting. I also wanted to get a view on the way ahead for the market, especially in the wake of rising competition from both banks like ICICI and merchants like Amazon that are coming with their own offerings. How do you see this entire market evolving in India over the next, say, 5 years?
Yeah, I mean, I think in the end, what will happen is, there will be very specialty, sort of call it
Hmm.
BNPL stuff happening, travel, and as I said, especially when the ticket sizes are high, right?
Right.
Consumer finance, consumer durables, so to speak, and all of that. And that is where a lot of Bajaj and HDFC and ICICI are doing. Then is, of course, so, and which is where, if you think about it, the value proposition of that EMI is the loan, and that's totally fine, because I'm spending 50,000 rupees or 1 lakh rupees, and I don't
Yeah.
do it often, so I just want to make sure I get the best terms, so cheapest interest rate, and so on. And if the user experience of filling up a couple of forms is taking me a couple of minutes, it's totally fine. And so I think that will continue to evolve, and I think obviously we know that India is incredibly underpenetrated in all these things, so I expect this to grow leaps and bounds, and that's going to be exciting. Then there will be, as you said, like more like pay later that is solving, or like pay later like Simpl, which is
Yeah.
solving the convenience and trust problem. And there, if you think about it, on the merchant side, merchants want a neutral company to be solving the problem for them. Amazon Pay is not that. Flipkart Pay Later
Yeah.
is not that. Flipkart Pay Later's goal is not to help the merchants' conversions. They're obviously the whole flywheel of Amazon is Amazon itself, and a lot of merchants are sort of running away from the marketplace, because they sometimes turn on them. So we are very different from that lens, right? Not just like, hey, there is a pay later thing, but like, and that's an important thing, right? It's less about what is pay later. Question is, what is the problem you're solving for the retailer? And the problem we are
Right.
solving is, we are retailers' best friend, and we empower them, so to speak, right? How the CEO of Shopify says, we are arming the rebels, right?
Yeah.
And making them strong. And does not matter how big or small you are, you have an independent, trusted counterparty like Simpl who can help you own customer relationship, convert more customers, and increase your sales, right? Right. And you have to never worry that Simpl will, sort of like do their own e-commerce at some point. And so therefore we are clearly different from something like an Amazon. And then the last but not the least is, for the reasons I told you, the pay later that is solving the sort of the where the user experience and convenience and trust are the main important value proposition, as opposed to, hey, I need a loan to buy my computer or my washing machine. There, the structuring of the product as an invoice to the consumer is the right structuring, because the consumer does not want to get into a deep financial contract each time they do something small on the internet, because the risk there is if they don't understand, and if they are doing it with everybody who's offering them something, then eventually it will be a permanent impairment to their credit score, which, as you can imagine, could be, severely detrimental, right? So structuring this product as a, what I said, the invoice, is super important, which obviously banks are not doing, and I'm sure they're not even thinking about it. And I don't think anybody else in the market is doing at all.
Fantastic, Nitya. This has actually been a very interesting conversation. So, on that note, if our listeners wanted to know more about Simpl and get in touch with you, what's the best way to do this?
Yes, to know about Simpl, you can definitely go to www.getsimpl.com, GETSIMPL, no E there, .com. If you want to reach out to me, you can always email me at Nitya, Nitya, at getsimpl.com. You can reach out to me on LinkedIn or Twitter as well, and you can search me on Google. You can find my Twitter handle.
Excellent, Nitya. We'll include those details in the show notes. Thanks a ton, Nitya, for taking out time to speak with us.
Absolutely. And Hemant and Elroy, great questions, and I enjoyed the conversation as well.
We enjoyed as well, Nitya. This has been a fantastic discussion. That's it from India FinTech Diaries for this week. Do keep an eye out on our website, indiafintechdiaries.com, for exclusive companion content on topics discussed on the show. And until next time, stay safe.